Hi, Jennifer Warren here. I'm not with my usual sidekick, Michael Hopkins. He was out ill today. And we were going to cover some of the developments in oil markets and the energy transition. There's been a lot of news in the oil markets because OPEC announced on the weekend, just the weekend past, that they were going to reduce Saudi Arabia specifically 500 million barrels a day, to include others in OPEC, making up over 1 million barrels a day reduction. And then if you add Russia into that mix, by July, it could even be up to 1.2, 1.5 or 6 million barrels a day reduction. So that was big news. And obviously, OPEC was trying to preempt any potential effects that a recession could have, and just put a floor under oil prices because they were trending downward. And now there's a floor right now with WTI, I think at 80 today in the futures market. And so that did the job. But there was an immediate reaction where the price of WTI and Brent went up like 5%, the next day, Monday, the trading day. And now, the dust is just settling, and it's not having a huge effect initially, but it could have an effect down the road once we see what happens with paying at the pump or not. And then I'm going to screen share some things to kind of flag some of the concepts that I was going to cover. And one other thing I will talk about after I cover a little bit about oil markets is with the energy transition. I was at an event last week, the McGuire Energy Institute, and there were 3 young men that spoke. One was from Bloomberg NEF, and he's the head of business development. And he gave a really good presentation, an overview of sort of their worldview of where the energy transition is at. And then there was one young man that has a business that focuses on greenhouse gas emissions, and it's all connected to the ESG movement. And he had some really interesting things to say about that. And then the third young man had developed a battery recycling manufacturing facility, some of them going to be sited next to gigafactories and things. And spent many years in the making doing this, and it's a real thing. We're going to be recycling metals, we're going to be recycling wind turbine blades, we're going to be doing a lot more recycling down the road with this energy transition, and that's a very good thing. So now let's look at some of these slides. Share my screen. I don't even know what that is. Okay, so this is just kind of encapsulating some of the news that an analysis that was coming out right after the OPEC announcement. It was, everybody was sort of giving their takes on what it means, what it might mean. And I thought this was quite good. And this was from Bloomberg. And this is a chart that was in their analysis. So basically, this is the person's name is Longview. And if you look right here in the first quarter 2023, right here, he was talking about or showing that there's a little bit of supply surplus, but that was largely driven because of the SPR releases from the United States government. Before that, we were having this tightness down here, with OPEC reducing supply. And now, when you incorporate OPEC's reductions, it's looking rather tight. See, they have the line going down here. Now, with these supply and demand balances, so what they're saying is, that's going to go down. It's going to be out of balance, basically. And the other thing that's interesting about this that nobody's really talking about, and I don't even know if I can see my notes, but the fact that if this is the case, if there's all this supply taken offline by OPEC, and then U.S. producers, I mean, with higher oil prices, U.S. producers, will respond to that. But they're still going to have capital discipline, like they have been saying, because they're not going to get, caught like they did before. And again, shareholders demand that there is capital discipline, and they want returns. And so I think there's this lack of spare capacity, with this supply cut by OPEC. I really haven't seen what the projections are for spare capacity just yet. And that matters because, as we know, oil prices are extremely volatile. And if there's one outage, if 1 million barrels a day goes offline somewhere, an unplanned outage, that will shoot the market up. And right now, the news is just that, there's an expectation of softer demand, and that is why OPEC cut. And then this other chart I wanted to talk about was actually something that I was looking at before this OPEC announcement. This news probably happened a week or two ago. Basically, this chart is showing that the volume of oil that forms Brent, the global benchmark, has been declining. And as we know, the UK's North Sea's oil, which is has been a big Brent constituent in the past, there's not as much production. One of the bigger producers is US Shale. They are in fact adding WTI in as a new constituent of the Brent index. And what that means is that US oil is going to be influencing the price of the global benchmark Brent more. So you'll have WTI still, but then WTI, which is the proxy for US oil, will also be included in the price of Brent. And that means that our oil, US oil, is going to be influencing roughly 2/3 of the oil market prices going forward. That's a huge development because and I've mentioned this before, back in 2010, we were only producing like 2 million barrels a day. Now, this is of crude. Now it's 12 as of 2019. That's 10 million barrels a day in a decade. And so that's a really significant development. And I think that's a good thing. It means we're going to be trading more oil and gas in the future. And I've talked about LNG before. I won't really be talking about it this time. So that's really a good thing, I think, for the future of some moderation in oil prices. Because as we know, OPEC still, and OPEC Plus, which includes Russia, still has the ability to whipsaw, the market around, but it increasingly course corrects faster, I think. And I think the influence of US oil is part of that equation. Let me just see here. Okay, so those are some of the other slides that we'll get to here in a minute. I'm going to stop sharing for a quick minute, and then I'll come back to that. So next, what I'm going to talk about is some of the energy transition happenings. Again, I was at that event where there was some interesting information flagged, and I've got these slides that I'm about to show from Bloomberg NEF, and Bloomberg NEF was whose slides I used back at the Fed, because they did a presentation in November at the Fed energy event, and they sort of were representative of the data used about the energy transition, because they are, huge data collectors at Bloomberg. And so one thing to note, though, that the gentleman presenting last week did say, because I asked about their view on the energy transition and what they're modeling, and they really believe that we're going to see a 2 degree Celsius world, as opposed to a true net zero world. So that's kind of the middle path. And I've got a slide that will speak to that. And the other thing to note is natural gas, and we've looked at natural gas in some of my former videos, but natural gas is a really not easy way, but it is an easier way to significantly reduce carbon emissions. And gas producers are also spending money investing in ways to even make that profile more green. And I know that the president of EQT, the CEO, he's been really on the road a lot. We've heard a lot from him, and he's absolutely right. It is the path of least resistance, and the rest of the world uses natural gas considerably in their power generation. And so just to get back to some slides, here we go. So now this was just really one of the big takeaways from this presentation. And these slides are actually from a Barrel of Tomorrow conference that was in Houston, and I just borrowed these slides because they speak to kind of what I wanted to talk about. But specifically, they're talking about how oil and gas is going to be a big player in the energy transition, and I've been talking about this for months. They are investing in low carbon initiatives. They were investing around 6%. That was the data from last fall that I had gotten from Bloomberg NEF when they presented at the Fed. And now it's closer to 8%, which I find kind of interesting. But this is just talking about, the oil majors' success. And, here we have, reserves. And as we can see, oil reserves down a bit. And this, I think, is reflective of some of the underinvestment story. And then over here, the break-evens, as you see, break-evens back in 2014, this was the very onset, really, of the shale oil boom in earnest, and I've chronicled that. And so the break-even was like, let's just call it 80 for the majors: Exxon, Chevron, BP, Shell, Total, Equinor, right here on this side. And then, as in 2021, it was closer to 40, 50 on the high side for break-evens. Well, new news, fast forward, this is from 2021. I just saw a Dallas Fed survey of oil and gas producers, and they were saying right now their break-even is around 62. That's a different world than 2 years ago. So that tells you how much inflation is impacting the break-evens right now, and also just the supply chain, the headwinds with supply chain issues. So it's all been increasing costs, and this is part of the inflation equation that the Fed is trying to fight, obviously. And then let me see if I can get to this next slide. Oh, and I would just add on the oil majors break-evens, it's not because they've just become more efficient in the last 7 years. It is because of shale. It is because that a lot of their production, like Exxon, Chevron, BP, Shell, Total, I don't know about Equinor, they all have bought considerable shale assets, and they're relying more on their oil production in shale, which over time, owing to technology and just practices and practicing, the US independents have reduced the cost of producing shale. So we have US shale to thank for the reduction of oil prices, the reduction of oil break-evens, and hence the reduction of oil prices. Now, this is just showing back to what I was saying, that they were discussing that oil firms are making, low carbon investments, roughly 6%. And this was during the pandemic. Now it's up to 8% of their CapEx. So they are, in fact, responding. Now, what's interesting so that's 32 billion that they're spending out of 400 billion. And also you see, this was the underinvestment here that had been happening because of the concern with demand destruction owing to, the climate change, ESG, all those trends. You see oil investment rising some, and that's just because of the recognition that, we do need energy security. And I've talked about how, Russia's war has sort of changed the narrative and the reality on the ground with some of that. So now the ways in which, now this is 2022, the ways in which oil and gas is investing in low carbon is varied. And I've discussed this before. They are focusing on their competencies. Exxon, CCS, and some sustainable fuels. And also, and they're doing more with, carbon capture, which is CCS. Chevron, sustainable fuels, renewable natural gas. Oxy, also CCS, including their direct air capture. And they're just, they're definitely leaders in low carbon initiatives. And they've stated as such, and they've set out on this path. And Warren, Buffett likes them and has continued to buy Oxy stock. Let's see. Next. So this is just some of the scenarios that Bloomberg's looking at and considering. And right here, about 20, right where we are, we're right around here. And this is the oil demand. And in a net zero scenario, obviously it goes down quite a bit. But this is their 2.6 degree warming scenario. So, that's above the 2 degree scenario that they were kind of saying they believed in. But there's probably some wiggle room. Now, the net zero version still gives 1.77 Celsius of warming. Now, the gas demand, and so it really looks like in this economic transition scenario, this is kind of where we are, what's on the books in terms of commitments by governments and oil players. And it looks to me like, it kind of continues. Demand doesn't really peak until after 2030, and then it just gradually declines. It's not a significant jump. It's not as significant as you would think. Now, here is the gas demand scenario. So here we are, roughly right around here in this spot in 2023. So they're projecting it goes down some in an economic transition scenario, and then it picks back up. And we know gas demand is just going to be there because with the renewables push, you need natural gas to be the reliable power generation source. That has been proven over the last year and a half. It was proven before the Russia invasion. We started seeing those cracks with Europe's green push, and hence, you have more LNG facilities being built in the United States and LNG receiving in Europe. So this is Bloomberg's projections in the United States for solar, wind, and EVs. Now, solar, the new outlook is this dashed line here, and this was the previous outlook. Now, what makes this go up a good bit is the US Inflation Reduction Act. As I'd mentioned before, there's like $128 billion of subsidies for solar, wind, and batteries. And then here, if you look at wind, what's interesting is the previous outlook, there was growth. Okay, we're right here, roughly. the previous outlook was for growth, but now it's greatly increased. Excuse me, there's a phone. Sorry about that. It stopped. So wind goes up considerably as a result of the Inflation Reduction Act. So the interesting thing to me is, okay, it was economic to do it, and we still have had, production tax credits, but now it really ramps up a lot more. And the other thing that could be weighing into this outlook is just the increased commitment of oil and gas to use renewables to reduce greenhouse gas emissions in their operations. You do see them pairing their oil production, the oil production going on in their fields. They are, pairing up with power gen sources that are renewable, and getting away from diesel and even natural gas over time. And then here, the EV outlook. Now, 2020% of total car sales, really low in the United States, small. They're projecting by 2025 that it's like 15% of new car sales. And then their new outlook is, increased, not greatly increased. There are the credits, the subsidies for EVs in the IRA legislation, but it doesn't markedly move the needle. So that whole electrification of transportation, which underlies a lot of the minerals requirements, that is really it's a little unclear to me compared to what a lot of the projections are. And now this I think is more clear. And something that Bloomberg talked about, and I think I've come to this conclusion as well. So in this molecules, hydrocarbon molecules versus electrons, which is electricity, when there's more electricity usage, which is what a lot of the net zero pushes about, you're going to be using less hydrocarbons. And then Russia kind of helped flip the script a bit. And now we're kind of like, okay, where's it going to go? Well, a solution by oil and gas is cleaner hydrocarbon molecules. And this is the sustainable aviation fuel demand outlook. And you see here in North America, we actually have the largest share of future outlook, for sustainable fuels in the aviation sector. And I think you're going to see that in other like light duty transport and things like that as well. Europe's up there, and obviously a lot of the fuel demand is, we're the two really heavyweight advanced economies with a lot of travel. We do a lot more travel. We're just wealthier countries. So it makes sense that we're going to have the lion's share of that demand. Asia Pacific's pretty low, Middle East as well, but it brings the world averages up in general. So I think that's a trend with legs for sure. And also a lot of the airlines are very much, this is their strategy to be more ESG friendly and net zero friendly. This right here is kind of just showing how long transitions take. So here in 1990, the cost of battery storage, high, $10,000 per kilowatt hour. And then by 2010, it had reduced, quite a bit, but it took 30 years basically. So now here we are in say 2015 that Bloomberg, observed, and it's gone down, down closer to 100, and they expect it to keep going down. But we're talking about, 15 years here to get battery storage at a lower cost. And then you have to work back all the supply chains for minerals. And it's going to take longer. I did ask a question about, how long start to finish? I mean, how is the United States going to catch up with the mining and the processing and all these things that they want to do to bring the supply chains back so that China's not dominating, the green energy supply chains. And the young man that does the metals recycling, maybe it was Bloomberg, like 15 years. It's going to take 15 years. Maybe you could call it 10 to 15, but what that says is it's going to take a while for this stock change to happen, and other things can happen along the way. I suspect we will become more efficient by necessity on what we're doing. Hydrocarbons, all of the producers are trying to reduce carbon emissions and carbon intensity in oil and gas production, cleaner barrels, and that's just going to continue. So oil and gas is really, I think, a really good place to, place a bet in terms of the energy transition. And they're spending the money to do the low carbon initiatives. And I think we're just going to keep, seeing interesting models developed as well. Now, I've talked about this in my Texas $1 Million Mile article, and this is some of the headwinds with electrification. And even interestingly, in Bloomberg's presentation, The Barrel of Tomorrow, they talked about that, there's not going to be quite as much electrification as we think there's going, or what was hoped for. It's just the reality of physics and the resources available on the planet dictate that. And so I looked at the case of Texas because we are well diversified in energy sources. We have a lot of wind resources. There's a lot of solar generation built and being built, which is still not tied to the grid. So you have all this capacity that's not being used. And we saw some cracks in that with our winter storm Uri. Now this is just showing, so ERCOT is the Texas grid. We have our own grid. Other states don't. And so we're kind of a pure clean test to look at this. So right here in 2021, 73 gigawatts of demand at a high point, probably in our summer, which, we can have over 100-degree temperatures for a couple months. And then here in 2023, it increases almost to 86 gigawatts. This, not only do we have a lot of growth in Texas, and I talked about that in the video before the war one in early January. Now, this addition, in addition to just the growth here, which is slowing down because of the interest rate rises, the economy is cooling a bit, but not like in other places. But this increased demand is due to Bitcoin mining. A lot of the Bitcoin mining left China, coming here because we have good power supply and we have the land. And so what this does is it really stresses out the grid. And they were actually projecting, there's another slide that I didn't even put up, that in 2023, this year, we could have some real problems because of this. And so I think, and I've heard of initiatives where you get some of the Bitcoin mining and things connected to crypto, trying to source cleaner power. And so I think you're going to start seeing those demand centers more expressly focused on clean energy. They have to. I mean, it's the only way we're all going to be able to use the grid and not overly warm the planet. So now this is talking about some of the firms, the laggards and the leaders in low carbon investment. Now, interestingly, the leaders, now, not surprisingly, European integrated oil companies. But what was surprising was some of the Asia Pacific refiners, and that is here on this end of the spectrum. Now, interesting, Total Energies, 16% of their CapEx is spent on low carbon investments. Valero, 11%, that's a refiner. BP and Shell. And we know that they have had a greener push for a while. And so this is reflected in that that aim of theirs. Chevron, considered a leader, not spending as much as the others, is going to be spending more. And again, the Inflation Reduction Act makes it so. They, because of their renewable natural gas business, oops, I just lost that. Sorry. You know, that's partly why I think they're on this part of the curve. And then you have over here on the laggards, you have a lot of the US independents lagging. But this is CapEx up to 2022. However, there have been a lot more carbon reduction pledges by all sorts of US E&P firms. And so that is going to get reflected differently in the future. And interestingly, too, we have Occidental, even with all their green push, they're here in the laggard area. But nevertheless, now this is just getting at all of the issue with OPEC cutting supply and why its impact is considered to not be as important as it might have been in the past. And that is because of earnings. The upcoming earnings season they're expecting a lot of downgrades in earnings, that the impact of inflation and interest rate rises will be now more visible in earnings than it has been in the past. Also, we know with the SVB and the banking crisis that happened just, a few weeks back, that also kind of put a pall on the market. So interestingly, this is the earnings expectations, and these have not been revised yet. They're expecting a lot of revisions. Technology was expected to be, doing well. Consumer discretionary, industrials, materials. So energy, they were projecting it being down. Now that's going to change because of the price floor that OPEC just initiated. Real estate down, expectation that it's down, financials down, healthcare down. So I think this energy section will be changed in the future. It's a real finicky market. And then this was just, I was looking at, again, the triple Q, which is the proxy for tech stocks, versus XLE, the proxy for energy. And then we have the S&P. So this is a 1 month look. Now, interestingly, so the triple Q up 7%, XLE down, CVX up 3%, Microsoft up 12%. So you can see the influence of Microsoft here. Microsoft was very much influencing the triple Q, and it's one of its top constituents. Actually, Microsoft and Apple make up the lion's share of the triple Q, and they have been supporting that index because, as I'll show you in a minute, everybody else has been bringing it down. And then this is just a result of the lower prices filtering through. This is a 1 year look. Now, I put FAANG in there. FAANG is Diamondback, and it is a top Permian producer. And then Meta has gone up 52% in the year, but that is of late. It's largely because of all the layoff announcements. Google 4%, Apple 15%, Netflix 44%. That's in the last year. They were still riding those tailwinds, post-pandemic tailwinds. Amazon down. So you see a lot of really differentiated movement here in these stock prices. But FANG, the oil and gas, over a year, decent return, because they were enjoying higher prices in this part of the curve. And then this is so on this one, this is a year look. REMX is rare earths, and I wanted to look at because rare earths is really a proxy for the minerals and metals, and down 4% over a year. S&P 15%, PIC, which is metals and minerals, up 20%. Vale, the mining stock, up 10. XLE 13, Triple Q 20%. Now, it's really interesting how stark it is with the rare earths. They tend to be, pretty volatile. PIC, interestingly, has been up higher, but that's just because of its constituents. And then this is just 1 month. Same story. Rare earth, REMX here, the orange line, not so much. PIC down too, Vale down, XLE a little bit down, Triple Q up. Again, it's interesting how the tech stocks, this was right here was when we had the banking crisis, right here, right, it was like between the 10th and the 14th. And then the Fed, intervened and didn't raise interest rates as much. So now you're seeing things kind of, come back that are going to come back. But again, there's a lot of uncertainty. I think that's the end of that, and I'll stop sharing. Again, there's a lot of uncertainty still as to, are we going to have a recession? How deep? How long? When? The jury's still out on all that. And supposedly upcoming earnings season is going to be very telling, because it is going to be really the first time that we're starting to see the starkness in the effect of interest rates, more so than we have. And one other thing to note about ESG and ESG ratings, the gentleman was noting that if you compare Tesla to ExxonMobil actually fared better in ESG ratings than Tesla. And that is largely because ExxonMobil disclosed more information. So there's a lot of gaps with ESG reporting. There's a lot of gaps with ratings. It's a real mixed bag. And the other thing that is happening is that big oil is starting to require that their supply chain be greener. So that is one way for them to have more low carbon, initiatives and be able to claim their carbon reductions, is that they're, having their supply chains do some of the heavy lifting for them. And they are as well doing the heavy lifting, but it's kind of a whole, downstream effect. And the gentleman that was doing these ESG sustainability reports was, at the ground zero of this. And it's just really it's an art and a science at present. It's not as much of a science as one thinks it is. So, just pick your ESG ratings carefully. Now it's becoming more scientific, but there's still a lot of gaps. Trying to think if there's anything else that I didn't cover. Just that, even the oil services, the large oil field services firms like Schlumberger and Baker Hughes, they're kind of in a really interesting spot in the energy transition, because they really have to lead on technology, because their clients are large oil and gas that expect them to lead with the oil and gas low carbon transition. So they're kind of in an interesting spot. And I haven't gone through and looked at all their investor presentations, but I suspect there's some really interesting information in that. So that I will conclude just to say that, again, it's a really interesting time. And then as we see geopolitics once again is, raising its head in oil markets as it always does. There's always something happening on the geopolitical front. And interestingly too, is that, I think the China news is kind of, died down a little bit in terms of, what the oil demand is going to look like, how they're going to influence, the market and demand in the future, because I think there's just so much more of an emphasis on the effect of inflation, interest rates, policy, and then you have in the mix the low carbon push, which really is not going to stop. I think this is a staying trend. And so that spot in the energy transition between oil and gas and renewables and everything in between is what's relevant and worth monitoring. Thank you.